What's up, guys? Welcome back to the channel. Today we're breaking down some really interesting comments from Dan Ives, the global head of tech research at Wedbush. He just went on CNBC's Fast Money to talk about the pullback we've been seeing in tech stocks, the state of the AI trade, and how investors should be navigating big tech right now. And here's the headline takeaway. According to Dan Ives, this tech sell-off is a huge buying opportunity. That's a bold statement, especially with all the volatility we've been seeing. So here's what we're going to do in this video. First, I'll show you the clip of Dan Ives on CNBC so you can hear exactly what he said. Then I'll come back and give you my detailed breakdown and reaction to his take. And after that, I'll dive into my own analysis of two of the best stocks to invest $1,000 in right now if you're looking to take advantage of this pullback. If you only watch one video today, make sure it's this one, and watch it all the way through to the end, because I think this breakdown is really going to change the way you look at the current market. Before we jump in, do me a quick favor. Hit that like button. Let's push this video to 1,000 likes, share it with a friend who's into investing, and drop your thoughts in the comments. And of course, make sure you're subscribed so you don't miss the next big update on the markets. All right, let's roll the clip and hear what Dan Ives had to say.
Dan, what do we make of the pullback on Palantir? Do you welcome it?
I mean, look, I think these pullbacks are almost healthy. I mean, that's been our view of Palantir. I mean, if you go back since, whatever, $10, $15, like, you're going to have these pullbacks, but I just continue to focus on the opportunity, and I think they're really transforming and disrupting software and tech. And it's my view, and I get the valuation, next 2, 3, 4 years, I think this is going to be $1 trillion market cap. They will grow into it, and they are the poster child of the AI revolution. The nervousness I get, but it doesn't in any way change our view fundamentally what's happened with the AI revolution, where Messi of AI Palantir sits.
All right, so $1 trillion, Dan, by the way, love your work. You know this. That's 3 times what it is now-ish. They're going to do, and I'm going to round up, $6 billion of revenue. What does that revenue line need to look like in order to justify $1 trillion valuation, in your opinion?
Yeah, I mean, guy, my view is that, and it's great to see it, you're ultimately going to be looking at 12, 15, 20 billion. My view, when you look out the next 3, 4 years for Palantir, and a free cash flow margin that could ultimately be 40, 50%. So I get the valuation today, but our whole view is when you have the 2 to 3 trillion that's going to be spent, I think Palantir, I mean, in 20, 30% of that, Palantir could win. So that's my view of it when you look out. And that's why pullbacks like this I get. But to me, it's not the time to run for the hills. It's actually, I view these as opportunities to own it, as well as a lot of these other tech names.
So, Dan, to echo Guy's sentiment, you have been spot on all these buying the dips. But let's look more micro. Let's look more trading-wise. Is it a tailwind or a headwind that they get 55% of revenue from governments, with the bulk of that obviously being from the USA?
Yeah, I think it's been, to some extent, a tailwind foundationally speaking, because that's really how they've really become that golden child in AI, because they've taken that technology into the enterprise, AIP, and that's how it's all transformed in terms on the commercial side. But I do believe from a valuation perspective, you're going to get the value on what you do on the commercial side. But government, as we see transformations on sovereigns, we're seeing in the U.S., you're going to see it around the world. Palantir, along with NVIDIA and Microsoft, I mean, they're going to be some of the first calls. And I think that's not being factored into what I view as a sovereign as well as a commercial opportunity.
Dan, it's Karen. Thanks for being on with us. So aside from Palantir, NVIDIA and elsewhere, I would assume that same 2 to 3 year time frame would hold for those as well. How do you sort of think this plays out? Why do you get 2 to 3 years?
Yeah, I mean, 2 to 3 years is a minimum, because it's my view that ultimately this is the second inning of this game, and we've talked about is that the use cases on enterprise, they're multiplying, they're up 30, 40% even when we look back over the last few months. And you only have 4% of enterprises that have even gone down the path in the U.S. You think about what that's going to happen in Europe, eventually what's going to happen in Asia, ex-China. And that's why, from NVIDIA to Microsoft to Palantir, to my view of Alphabet, as well as the software names, you look at autonomous, you look at names like Aqua. I mean, that's our thesis. Our thesis it was 9 p.m. It's now 10:15 p.m. at the AI party. That party goes to 4 a.m. And I think these are always opportunities, even though the DJ could stop playing the music for, a few minutes.
You got the musical references, you had the Messi reference in there, but let me ask you this. Even Messi has bad games. Dan, what is the risk profile on Palantir?
Look, obviously, high risk profile. If you have any hiccup, any speed bump, stock gets crushed. But Brian, my view is that's why we spend so much time in the field in terms of what we see. And they're seeing, I think it's 10, 15 to 1 demand to supply relative to what they could do with no direct sales force. And that's why I think this will ultimately be $1 trillion company. I think CARP has the vision.
All right, so let's talk about what we just heard from Dan Ives, because he gave some really strong takes on Palantir, the AI market, and how he's looking at the next 2 to 3 years for tech stocks. Now, the first thing that stood out was how he framed the current pullback in Palantir. The stock has been sliding for 6 straight days, down almost 18% from its recent highs. For a lot of investors, that's enough to trigger panic and start thinking about selling. But Dan Ives takes the opposite stance. He actually welcomes the pullback. In his view, these dips are healthy, and they're opportunities to own the core winners in AI, not moments to run for the hills. And here's why. Ives believes Palantir isn't just another software company, it's the poster child of the AI revolution. He projects that over the next 2 to 3 years, Palantir could grow into $1 trillion market cap. Right now, they're doing around $6 billion in revenue, so to justify $1 trillion valuation, that line would need to jump closer to 12 to 20 billion in the next 3 to 4 years. He sees that as achievable, especially because he's modeling free cash flow margins in the 40 to 50% range, which is massive. The key point here is that Ives expects $2 to $3 trillion to be spent across AI over the next few years, and he believes Palantir could capture 20 to 30% of that. That's the foundation of his bullish thesis. Now, one of the criticisms that often comes up with Palantir is that about 55% of its revenue comes from government contracts, with a heavy reliance on the U.S. government. Some people see that as a headwind because it might mean limited growth outside of defense and intelligence. But Ives spins this as more of a tailwind. He argues that Palantir used its government roots as the foundation to prove itself, and now it's taking that same technology into enterprise AI. That's where the big upside is, on the commercial side. He also makes the point that as sovereign governments around the world adopt AI, Palantir will be one of the first calls alongside names like NVIDIA and Microsoft. And that global sovereign angle, he says, isn't even fully priced in yet. Then we get to the time frame. The interviewer asked him why he keeps emphasizing this 2 to 3 year bull cycle for tech. Ives says 2 to 3 years is the minimum. He thinks we're still in the second inning of this AI game. Only about 4% of U.S. enterprises have even started down the AI adoption path. When you think about how that's going to scale across the US, then Europe, and eventually Asia outside of China, he sees the use cases multiplying at a rapid pace, up 30 to 40% just over the past few months. To drive the point home, he uses this party metaphor. He says if the AI party started at 9 p.m., right now it's only 10:15, and this party goes until 4 a.m. So yes, the DJ might pause the music for a few minutes here and there, meaning there will be pullbacks, dips, and volatility, but overall the night is just getting started. That's how he frames his view of the current AI cycle. Now, of course, he doesn't ignore the risks. He admits Palantir is a high-risk profile stock. If the company has any hiccup or stumbles in execution, the stock could get crushed quickly. That's the trade-off with high-growth, high-valuation names. They're volatile. But his conviction comes from spending time in the field and seeing demand firsthand. He claims Palantir is facing something like 10 to 1 or even 15 to 1 demand relative to its current supply and capacity. That imbalance is part of why he's so confident they'll grow into that $1 trillion valuation over the coming years. So if we sum it all up, Dan Ives' message is this: don't let short-term sell-offs shake you out. Pullbacks in leaders like Palantir, NVIDIA, Microsoft, and even Alphabet should be seen as buying opportunities because we are still very early in the AI adoption curve. Palantir, in his words, is the poster child of this revolution, and he sees the potential for the company to triple or more in value as AI spending explodes worldwide. That's my breakdown of what Dan Ives had to say. Now, I want to hear from you. Do you think Palantir has what it takes to grow into $1 trillion company, or is this just too much hype too early? Drop your thoughts in the comments below, hit that like button if you found this breakdown useful, and don't forget to subscribe for more deep dives into the biggest stories shaping tech and investing. Now let's dive into the 2 best stocks to invest $1,000 in right now. First up, let's talk about a company that is quietly powering the next generation of digital innovation. I'm talking about DigitalOcean, ticker symbol DOCN. Now you might hear cloud computing and immediately think of the giants like Amazon Web Services or Microsoft Azure, and you're not wrong, they are the big dogs. DigitalOcean saw a massive underserved market, the small and medium-sized businesses, the startups, and the individual developers who need powerful cloud tools without the complexity and crippling costs. DigitalOcean's business model is brilliantly simple. They provide cloud infrastructure, virtual servers which they call droplets, managed databases, and object storage, with a focus on simplicity, ease of use, and transparent, predictable pricing. A developer can spin up a server and get their application running in less than a minute. There are no confusing contracts, no hidden fees, and no need for a PhD in computer science to figure it out. They are the Shopify for cloud infrastructure, empowering the little guys to compete with the giants. This focus on the small and medium business market is not a weakness, it's their greatest strength. This is a massive, fragmented, and fast-growing segment. These are the businesses building the new apps, the new websites, and the new digital experiences that shape our world. DigitalOcean provides them with the foundational tools they need to grow, and as these businesses scale, their spending on DigitalOcean's platform scales right along with them. So what makes DigitalOcean so special? It comes down to three key ingredients: radical simplicity, a powerful community, and unbeatable value. First, simplicity. Big cloud providers are incredibly complex. They offer thousands of services with pricing models that can be a nightmare to understand. DigitalOcean cuts through all that noise. The second ingredient is community. DigitalOcean has built one of the most extensive and helpful libraries of tutorials and tech articles on the internet. This creates goodwill and strong brand loyalty. It also acts as a marketing engine, drawing in millions of developers searching for solutions. The third ingredient is value. DigitalOcean offers enterprise-grade performance at a price small businesses can afford. Their transparent, predictable billing means no surprise charges. When you put these three things together, simplicity, community, and value, you get a business with a deep and defensible moat. The global cloud market for small and medium-sized businesses is already enormous, estimated to be worth over $100 billion, and it's growing at a rapid pace. DigitalOcean currently has only a small slice of that pie. This isn't a story about a company dominating a shrinking market, it's about a nimble disruptor capturing more and more share in a massive, expanding ocean of opportunity. Second, look at their customer metrics. DigitalOcean has a fantastic net dollar retention rate, which means their existing customers spend more money with them over time. Furthermore, DigitalOcean is expanding its product portfolio. They recently acquired Cloudways, a managed hosting provider. They're also investing heavily in new products around AI and machine learning, making these powerful technologies accessible to smaller businesses. This shows that management isn't sitting still. They are actively innovating to meet the evolving needs of their customers, which will fuel the next leg of their growth journey. The stock itself has been beaten down by Wall Street, which has been overly focused on short-term macro headwinds. At its current valuation, you are getting a premium growth company at a discount price. The company currently sits at a market cap of about $2.73 billion, with earnings per share of $1.39 and a price-to-earnings ratio of 21.58. For 2024, DigitalOcean reported revenue of $780.62 million and net income of $84.49 million. Right now, the stock trades at $29.99, which is about 11% below its fair value estimate of $33.38. Now here's where things get interesting. In Q2 of 2025, DigitalOcean delivered a 14% year-over-year revenue increase, showing strong demand across its services. That's the highest incremental annual recurring revenue the company has seen since late 2022. This kind of performance gave management enough confidence to raise full-year guidance, which in turn boosted investor sentiment. On top of that, the company recently closed a $625 million convertible senior notes offering, raising about $605.6 million after expenses. That move strengthens its balance sheet and gives DigitalOcean more flexibility going forward. What really excites me is their AI push. They've launched products like Cloudways Copilot and the DigitalOcean Gradient AI platform, both aimed at helping customers tap into AI more effectively. With how fast AI is reshaping the tech landscape, these initiatives could bring in new clients and add another growth engine for the business. And investors are starting to notice. The stock has jumped nearly 30% following its earnings report, and analysts have raised price targets pointing to even more potential upside. While DigitalOcean does face the challenges of competing in the crowded cloud space, its financial momentum, innovation in AI, and recent fundraising efforts show that the company is building a solid foundation for long-term growth. The market is giving you a gift. The question is, are you smart enough to take it? All right, shift gears. Let's move from the world of cloud software to the hardcore hardware that makes it all possible. I'm talking about the undisputed king, the master of the universe when it comes to silicon. The one company that is absolutely essential to our modern world. I'm talking about Taiwan Semiconductor Manufacturing, ticker symbol TSM. Folks, listen to me. If you own a smartphone, a laptop, a smart TV, or a modern car, you are using TSM's products. They don't design the chips, but they manufacture them for everyone else. They are the world's foundry. Their business model is pure genius. Companies like Apple, Nvidia, AMD, and Qualcomm spend billions designing the most advanced chips in the world. But building the factories or fabs to produce these chips is astronomically expensive and incredibly complex. So these brilliant design companies outsource the manufacturing to the one company that does it better, faster, and more reliably than anyone else on the planet, TSM. TSM's dominance is staggering. They control over 60% of the entire global semiconductor foundry market. But here's the kicker. When it comes to the most advanced, cutting-edge chips, the ones that power AI, high-performance computing, and the latest iPhones, their market share is over 90%. Read that again, 90%. This is not a monopoly, it's a technopoly. They are so far ahead of competitors like Samsung and Intel in terms of technology and manufacturing prowess that it's almost impossible for anyone to catch up. They're playing a different game entirely. It's like trying to catch a speeding bullet. By the time they reach where TSM is today, TSM will be light years ahead. Think about the massive trends shaping our future: artificial intelligence, 5G, the Internet of Things, and electric vehicles. What do all of these have in common? They all require more and more advanced, powerful, and efficient semiconductor chips. And who is going to make the vast majority of those chips? You got it, TSM. They are not just riding these waves of innovation, they are the surfboard that everyone else needs to ride them. When I look for a great company, I look for a fortress, a business with a wide, deep moat that keeps competitors at bay. Taiwan Semiconductor doesn't just have a moat, it has a piranha-infested moat protected by laser-guided cannons on top of an unassailable mountain. The first part of this moat is their technological leadership. TSM is consistently 2 to 3 years ahead in developing the next generation of chip manufacturing processes. This technological lead is a self-reinforcing cycle. Because TSM has the most advanced technology, all the top chip designers bring their most important products to them. This gives TSM the volume and revenue to reinvest tens of billions every year into R&D, which further extends their lead. Competitors like Intel are spending a fortune trying to catch up, but it's a race they simply cannot win. The second part of their moat is manufacturing expertise and scale. Manufacturing leading-edge semiconductors is arguably the most complex industrial process ever devised, requiring unimaginable precision, flawless execution, and deep institutional knowledge. TSM has perfected this process. Their production yields are the best in the industry, making them the most cost-effective and reliable choice. Finally, their moat is deepened by high switching costs. Once a company designs a chip for TSM's process, it would take years and billions of dollars to redesign for a different foundry. They are deeply integrated strategic partners. This fortress is impenetrable, and it's why TSM will continue to dominate for decades to come. So where does growth come from? The AI revolution happening right now. AI models like ChatGPT and self-driving cars require specialized chips like Nvidia's GPUs, and TSM manufactures virtually all of them. Beyond AI, every industry is becoming smarter. Our cars are computers on wheels, our homes are filled with smart devices, our factories use intelligent robots. A modern electric vehicle can have over 3,000 chips inside it. As the world digitizes and automates, demand will only accelerate. They are the foundational layer upon which this technological future is built. Let's look at financials. TSM is a cash-generating machine with incredible margins and massive free cash flow. They reinvest heavily into advanced fabs, strengthening their moat, and return cash via consistently growing dividends. The company boasts a market cap of around $1.21 trillion. Its earnings per share sit at 56.30 Taiwan dollars, with a PE ratio of 20.16. For 2024, revenue reached 2.89 trillion Taiwan dollars, while net income came in at 1.17 trillion. TSMC's growth story is tied heavily to AI, and the numbers show it. Revenue from its advanced nodes has climbed to 69%, thanks to soaring demand from AI chips and huge investments in new facilities, especially in the United States. Looking ahead, management has raised its sales growth forecast for 2025 to 30%, which is a jump from its earlier estimate of 24 to 26%. That's a strong vote of confidence in their near-term future, and when it comes to market dominance, TSMC is only tightening its grip. They held about 33% market share in 2024, but they're expected to expand that to 36% by the end of 2025. That might not sound like a huge leap, But in the semiconductor industry, those percentage points represent billions in revenue and deeper industry control. So, while TSMC stock has had its ups and downs like the rest of the chip sector, the fundamentals remain rock solid. Its leadership in advanced manufacturing, combined with the relentless demand for AI, positions the company for long-term growth. The upgraded sales forecast is just another signal that TSMC isn't slowing down anytime soon. Wall Street worries about geopolitical risk, but the world depends on TSM. The global economy would halt without them. That creates a silicon shield incentivizing stability. You're getting the most important company in the world at a valuation that doesn't reflect its role in fueling the future. This is an opportunity you can't afford to miss. We've just gone through two incredible companies, DigitalOcean and TSM. You see the potential, you feel the energy, and you're ready to take action. But what about the next great opportunity? And the one after that? Giving you stock picks is great, but teaching you how to fish for these winners yourself is where real wealth is built. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For those who want to take your investing game to the next level, I personally invite you to join the StocksGalore Patreon. This is where you get exclusive deep dive analysis, my personal watch list, and behind-the-scenes content. It's the inner circle for serious investors. You get more direct access, detailed content, and join a network of like-minded investors on the same mission, to build lasting wealth. We share ideas, challenge each other, and find the next big winners together. If you're ready to go beyond the surface, our Patreon is for you. Now I want to turn it over to you. You've heard my take, now I want yours. Here's a fun question for the comments. Besides tech, which industry do you believe has the greatest untapped growth potential for the next 5 years? Healthcare, renewable energy, industrial automation? There are no wrong answers. Let's get a great conversation started in the comments. I read them all. Finally, you know the drill. If you got value out of this today, show some love. Hit that like button, comment with your answer to my question, and share this with someone who needs to see it. Most importantly, if you haven't already, subscribe and ring that notification bell so you never miss our next big idea. Thank you for tuning in. Stay smart, stay hungry, and I'll see you on the next one. Booyah!